Hello, everyone. I'm Dan Turbyville, and this is Powerhouse Fence Show. And hopefully, you can hear me. I could not hear the intro music, and I normally can, so that has me a little bit concerned. But anyway, I'm just going to start talking, and hopefully, it works out. So, welcome to the show. This week, we're doing part 2 of the financial information that you need to know. This time, we're going to cover balance sheets. So, we're going to talk about assets, liability, equity. We'll talk about what it means, what it does for you, what is it good for. And so, like I mentioned, this is part 2. A couple weeks ago, we went over an income statement. Last week, I just went live for a few minutes sitting at my desk because Simpolo was broken, and I'm still fighting that fight. It's a part of the reason why I'm 30 minutes late right now. So, fun stuff. But we're not going to fuss about that this week. We're just going to move along, okay? The show's presented by Memphis Fence Company, Simpolo, and Valguard Strategies Groups. We have some partners listed across the bottom of the screen down here. We have Fence News, fence industry publication. My Salesman, they're a lead qualifying software. And then we have EasyG Manufacturing, big orange equipment you see at trade shows, Fence Hog, Mud Hog, things like that. Attachments for big skid steers and small skid steers. And finally, we have the Thornton Fence Consulting Group. If you want to know more about any of them, there are links in the description. You can go check them out. This is live. I try to talk about, reading books and things that I've been working on and stuff like that, right? And so we're still doing From Drift to Drive by Chris Robinson at our office. We have our own book club thing going on. Simultaneously, a few of us are in a mastermind with the Purple Coaching Group. And right now we're doing the 15 Invaluable Laws of Growth by John Maxwell. It's a lot of stuff to be taken in at the same time. And I'm still, listening to podcasts while I drive. I don't really listen to music. Driving back and forth to work, I've got like a 45-minute drive, and most of that's just podcast. I am actively looking for some intentional or focused content, right? Something that's going to kind of help me to see the path from where I am to where I want to go. And haven't quite found anything that's really that yet, but I am on the hunt, and I have some things to check out. As always, I appreciate all of you tuning in. I appreciate you being here. That's what I do it for every single week. I sit here and talk just so I can hopefully share something with someone out there. So if I share something with you and you run into me, it's always super cool whenever people tell me. And that's pretty much it. You can listen to the audio only version of it. It's on all major podcast platforms, Powerhouse Fence Show. You can find us there. Okay, so I want to do a real brief recap of what we talked about in the last episode, and then we're going to get into what balance sheets are and dive into that. Okay, so like I told you, we talked about income statements. So we went through like a whole profit and loss statement, an income statement, whatever you want to call it. We started at the top line, revenue, which was what we invoiced or jobs that we billed. And then we went cost of goods sold. So all of our direct costs for completing that project. Then we went gross profit. Revenue minus cost of goods sold is gross profit or your margin. And then we talked expenses, which is our overhead, our indirect cost, everything lumps into there in expenses. And then we have net profit. So what's left over after we do revenue minus cost of goods sold minus expenses, right? If you want to know more about that, go find the episode from 2 weeks ago and you can enjoy hearing me talk about that. But that's not what we're doing today. But your income statement, it was a way that you could tell if you made money during a certain period of time, right? You could look at it for a week, for a month, a quarter, a year, whatever you wanted to look at. I sometimes look at them over the course of like 10 years. I really like to do that. And then I like to set my columns to be the years so I can see every year stacked up side by side, and I can see trends, and I can see how things move, and I can see what's better and what's worse, and a lot of things that just make me scratch my head. So anyway, It's a way to tell if you made money during a set period of time. Like I said, could be 10 years if you want. This week, we're going to talk about something different. So, this week, we're going to talk about balance sheets. Okay. And just like when we talked about the income statements, balance sheets also follow the same, I don't know, idea that there's both cash basis and accrual based accounting. Okay. I know people listening are going to fall into one of those two categories. It's kind of hard to do this and be like, well, if it's cash based, here's how it works. If it's accrual based, here's how it works. There is some of that in here, but just know there's some nuances there. Okay. So the numbers will be a little bit different depending on what accounting method you used, and the stuff is going to be just a touch different. But anyway, just throwing that out there. So what is the balance sheet going to tell us? Well, it's going to tell us, are we financially healthy? Okay, because companies can show a profit on their income statement, on their P&L statement, and still go bankrupt. And so there are more financial information documents. There is more financial information we need to look at other than just an income statement, although it is important. So a balance sheet is a financial statement that reports a company's assets, liabilities, and equity at a specific moment in time. Right? A lot of people do it at the end of their year, right? That maybe is December 31st, it maybe is in June, it's wherever it is. Your year ends, and a lot of people want to look at balance sheets then. I don't really get into this, but I will say it, if you really want to dive in there, there's like work in progress, work in process. I don't remember which term it is. Entries that need to be made. You've got to like move payroll back and forth across that cutoff line to really get a good picture, because again, you're taking a snapshot. So if we work all this week and say the end of the year is Thursday, well, then that payroll is not going to be paid until next week. And so we'll make an entry to move some of that payroll back into the previous year, and we'll move, jobs that are partially completed and stuff like that around to try to get as close to accurate as we can on that snapshot in that moment. So there are entries like that need to be made. Not really going into that today. But if someone asks you, what do you own? Okay. Or what are your assets? It's found on your balance sheet. If they ask, what do you owe, or your liabilities, balance sheet. And if they said, what is your company worth? It's kind of a weird thing, because what you own or your assets minus your liabilities equals equity, which is kind of a worth, right? But it's not actually what you would sell it for. We'll get into that a little bit more later. But your balance sheet answers the three questions. What do you own? What do you owe? What's it worth? All right. Very high level. So the entire statement is built around one fundamental accounting equation, which is assets equals liabilities plus equity. All right. Remember, those three things: assets, what you own; liabilities, what you owe; equity, what it's worth. So that has to balance. If you look at your balance sheet and you're out of balance, like if you try to send that to a bank or anybody else, they're just kind of going to go, huh? And in fact, QuickBooks or any other accounting software that's out there really does a good job helping you not get out of balance, but it doesn't make it impossible. We've had our balance sheet where the assets and the liabilities did match several times, and it's always been a giant pain in the butt. And a lot of times it's because of some sort of corruption within our QuickBooks file that has to be repaired and all that. So that's neither here nor there. A little bit of history. Okay. If you've listened before, I love history. I love looking back and seeing what other people have done before us. So this is really crazy to me. Okay. The modern accounting principles, which includes your balance sheet, your income statement, all of this stuff. Most of what we use in modern accounting is built on a system that's called double entry bookkeeping. And that double entry bookkeeping was formally documented in 1494 by an Italian mathematician whose name I'm not going to do a good job of. If you've been listening for a long time, we used to try to learn Italian with Ilaria, and I always did terrible at that. But this Italian mathematician named Luca Pacioli. So he didn't invent accounting, but he wrote the first widely distributed explanation of how merchants in Venice were already keeping their financial records. Okay. So his system required that every transaction had two accounts, which is why it's called double entry. All right. One shows where the money came from, and the other shows where the money went. And that's credits and debits. If you want to go really deep, you can go look that stuff up and you can kind of start seeing how entries have to balance. Different accounts are either credit accounts or debit accounts. And you can go deep into that world if you want, but we're not here to get an accounting degree, right? We're just here to kind of have a high level understanding. So if money goes somewhere, it has to come from somewhere. Pretty earth shattering stuff. That is the idea that's the foundation of the modern accounting systems that we use. Also, merchants in Renaissance Europe, they used balance sheets so they could understand their trading companies, right? So they could understand what they owned, what they owed to their investors or lenders, and they could just kind of see if they were financially stable and get an idea of the overall financial health of their businesses. So it's been going on for hundreds of years. Today, balance sheets are normally required by banks, investors, if you're a public company, right? That's there. But the IRS, a lot of times different government regulations and things like that. But the biggest ones that I worry about are banks, right? And our contractors license, we got to provide a bunch of financial stuff for those. So those are kind of my primary focuses when I talk about this, and it's important. Okay. So with that, now we have an idea what it is, where it came from. So let's go a little bit deeper. Okay. We're going to look at assets first. So an asset is a resource that's owned by the company that has economic value and expected to provide future benefit. I'll tell you, let me just pause right here for a second. And let me tell you, I do real research for this stuff. And the research that I do, I try to tie back to GAAP, which is GAAP, and I think it's like generally accepted accounting principles. Um, and so the stuff that I'm talking about in here, it's all tied back to that, right? So it's not like these are the exact definitions that you would find in some textbook somewhere. It is paraphrased and it's made a little bit easier for us non-professional accountants to understand. But anyway, it is legitimate stuff. Okay. So assets are simply everything your company owns. All right. Again, the cash versus accrual thing, right? It might show up a little different, but it's the stuff that you own. So normally when you talk about assets, here's a few things that you might show up in there. Okay. And this is going to be money in the bank, cash that you have. So that may be in operating accounts that you use to pay your bills, pay payrolls, where you deposit money when it comes in, things like that, right? Your operating accounts, or maybe savings account. Maybe you have a money market account, maybe you have CDs, maybe you have petty cash, maybe whatever it is, right? If you have kind of like immediate cash that you could use to pay bills next week, that is all lumped into one cash line item right here. Okay. Your accounts receivable. So that's money that people owe you, typically your customers, but not always, right? So money that people owe you. And this is again, kind of where cash versus accrual gets weird, right? But uh, when you create an invoice, because we're all creating invoices, no matter if you're cash or accrual, you're billing out of your accounting system, I hope. And when you create that invoice, whatever the amount of it is, it shows up as an accounts receivable. All right. Because it's money that is owed. So the big difference in the cash and accrual is, your revenue, going back to your income statement, your P&L, your revenue only shows up when you receive the cash on cash based. Whenever you're accrual based, the revenue shows up when you create the invoice. So balance sheet wise, not a huge difference. You're going to have accounts receivable either way. But accounts receivable are an asset. It's a thing that you own. It has economic value and it is expected to provide future benefit for your business. So it's an asset. All right. There's Now, this is a fun one. There's a thing called undeposited funds. So if you ever are looking around in QuickBooks, you don't really understand what you're looking at, you're trying to learn, you're curious, right? You see something called like undeposited funds or money to deposit or any phrase that kind of fits that same definition. So what is this? Well, when you go and you receive a payment for an invoice, you typically go in and you mark that invoice as paid, right? So Mr. Jones owes $10,000. Mr. Jones hands me a check for $10,000. I go mark it as paid in QuickBooks, but I don't immediately deposit it, right? And so there's some time from when I receive the money until I actually deposit it. And that is when that money is going to sit in this undeposited funds or money to deposit or whatever that is. Once you go make the deposit into the bank, the money will move from your undeposited funds into your cash. So it sits in, you create the invoice, it hits accounts receivable. You receive the check, it goes to undeposited funds. You deposit the money, it goes to your bank account, right? So that's kind of the flow of how the amount of that invoice goes through your business. And guess what? All of those are assets, right? So even if it's accounts receivable, if it's undeposited, if it's cash, it's still sitting in assets. So no matter which place it is, still an asset, just different buckets to different pieces of the same bucket, I guess. So hopefully that makes some sense. But I will say, okay, make sure if you're doing this and money is going into an undeposited money to deposit, whatever it is type of account, make sure you actually record the deposit against that amount of money to be deposited. Otherwise, you wind up with this giant monster account that's a real pain in the butt. Okay. So when you go deposit checks, there is this issue. And I've experienced this issue. Everyone's experienced this issue. If you're using QuickBooks Online, you're like, man, it's tied in my bank account. I ain't got to worry about it, right? You go deposit some checks. You deposit a big old fat stack of about 18 checks, but you didn't write down what all 18 checks were, right? And then you have to go back because now you have a deposit that is just the sum of all those checks, and you got to try to match it to all 18 of those. So make a record, and that's going to make that process a lot easier. Me, when I had my farm and I was doing accounting in there, it was exactly like this. And all I would do is I would take all the checks and I would take pictures of them, and then I would go deposit them. Maybe not like the best idea, right? Because yeah, it's a picture on my phone, but it was the way I did it. So here we are. You probably also can sit down and like go through and do a deposit in QuickBooks and match them all up before you go put the money in. Probably would be the real way to do it. But you know, we're busy, right? And we got a stack of money in our hand. We want to get it in the bank. So at least take a picture of it. All right. The next asset is inventory. So this is material that you own. So I learned about the history of accounting while I was doing this research. All right. I had no idea that the modern day accounting system was over 500 years old. That's insane. Inventory is another interesting thing to talk about. Inventory, obviously, right? Oh, you call and, you know, somebody orders a truckload of wood, right? Well, you receive that, it goes into inventory. That's pretty self-explanatory. Okay. But what if it was purchased for a job, right? And because you listened a couple weeks ago, you know what cost of goods sold is. So I'm not going to describe this. It was purchased for a job and it was recorded in the cost of goods sold for that job. All right. But then you have some left over. So now what? Well, you move the material from cost of goods sold back into your inventory, whatever you have left over. Now, there is a materiality rule. And I don't have the definition of that rule. I don't know if it varies by company. I should have done a little more research on that word, but I was like, oh, yeah, cool. I understand if it's a material thing or not, right? But I don't know what the threshold is. So if you have like very small leftover amounts, then it's kind of like, right? Because the amount of energy and effort it takes to make the entries to move it from cost of goods sold back to inventory outweighs the benefits that you're going to get. But the proper practice is to take it from cost of goods sold, move it back into inventory when it's left over. And then in what happens to us a lot of times is it's like some special order stuff, right? And we've used it one time in the past decade. Well, guess what? Odds are we're not going to use it again. So we have this stuff left over. Now, I move it from cost of goods sold into inventory, hypothetically. And then 5 years from now, I get tired of looking at it and I put it on Facebook Marketplace for $10 or I haul it to the scrapyard or whatever that is just to get rid of it. Well, now that should become income and it should reduce your inventory by that, because it should reduce the items that you put in inventory before. That's the technical way to do it. All right. Just throwing that out there. Right. Do with it what you want. But that is the technical way. And so that's another piece of the research that I did for this episode that I thought was pretty interesting, right? Is that you're supposed to remove it from cost of goods sold, put it back in inventory. Then when you sell it, it goes into revenue and cost of it. Like that's a mess. That's such a pain in the butt. I get if you do a 5,000 foot job and you got 2,000 foot of material left over, like, yeah, that's something, right? But if you do a 5,000 foot job and you got 100 feet left over, it's like, right? Okay, equipment and machinery are also assets. And then trucks and trailers, buildings, land, all of that kind of stuff that your company owns. Again, it has economic value and it's expected to provide future benefit. It becomes an asset. All right. Now, assets are broken down into two categories, and you'll hear these same two categories here in a minute when we talk about liabilities. So, assets that are expected to convert into cash within 1 year. Let me say that again. Assets that are expected to convert into cash within 1 year are current assets. Okay, so examples of that are, well, cash. I would say there's a pretty good chance it's going to convert into cash. Accounts receivable, short-term deposits. So this is where some of those other account types go, right? Because this is cash that's temporarily parked somewhere to earn interest, but it still can be, you still have access to it within your year window, okay? So if you needed the money, you could get it pretty quickly. It's a short-term deposit, which is a current asset. CDs, treasury bills, some kind of high yield savings account, money market account, things like that. So CDs, that was interesting to me, right? And I guess generally CDs are expected to mature within a year, so they fall into this category, although there are some that are more than a year. Yeah, well, anyway. But even with CDs, you can get the money out of them quickly. So the first time I ever bought a CD, I was like, man, this is so scary, right? Like I went a lot of years of owning Memphis Fence where I was like, holy crap, how are we going to pay payroll and how are we going to pay these bills and how are we going to do all these things? And like rode the struggle bus for a long time. And I, by no means am I saying my days of that are over. Okay. I've been very blessed recently and haven't been there recently, but it's not like we're just rolling in money neither. So don't think that. But the first time I bought a CD, man, I was like, this is insane, right? Because this whole time, like I've been worried about money and now I have a little bit of money sitting here that I need to do something with and decide to put it in a CD. Right or wrong, whatever. You can get a loan against a CD. So hypothetically, if you had $50,000 cash, you could put it in the bank and then you could get a loan against that CD. And I think there's like rules about how much interest they're allowed to charge you over what the CD is paying, which I think is like maybe 2% or something like that. It's a good way to get a really low interest rate is what I'm saying. But anyway, so I was a little freaked out. All right. I'm trying to tell the story. I keep getting sidetracked. I was a little freaked out and I was like, man, what happens if I need the money? Right? This is a 12-month CD. Like, what happens if I need the money? Well, they said, oh, all you got to do is tell us. Right. And we just penalize you the 1 month. And I was like, oh, okay. Well, we're penalized 1 month worth of interest off the CD and I can just have the money back. Yeah. All right. Well, that's cool. I didn't know that either. But anyway, so those are all current assets. Okay. Current assets. These are what fund your operations. Again, something that you can turn into cash quickly It's expected to convert into cash within 1 year. All right. Current assets. So then you have long-term assets. Now, long-term assets are expected to last longer than a year. Weird. These are trucks, equipment, buildings, property, right? You get the idea. Things that typically you have and operate in your business for longer than a year are long-term assets. And they say they're not quickly converted into cash. I think that's kind of a maybe, right? Because, I mean, if you have a truck or a piece of equipment or trailer or tools, like you could put it up for sale and you could turn it into cash, but that's not what the expectation is. And so I think to me, that expected word meant a lot. Someone is calling me. Yeah, just some junk call. I don't think they want to be on the show. So, anyway, long term assets, things that are expected to be in operation in your business for more than a year. Okay. Now, let me take a drink. Hold on. Interesting. So, I ran out of, I don't know if you know, but I drink tea. I ran out of the tea that I normally drink. And during Christmas time, we made a bunch of, Jamie and Alyssa and some other people in the office, they made a bunch of these baskets, these like gift baskets that were all given away to different customers and some vendors and subcontractors and stuff like that. And what they wanted to do was source stuff locally. And so they did a lot of looking and they found, like some chocolates and some tea and some coffee and some other things like that that were all Memphis based companies. And this is the tea that I'm drinking that is from a Memphis-based company. I believe it's called My Cup of Tea. And the box of tea that we got, they were all like kind of sample pack. And I think they had like 5 or 7 different flavors in it. And the names of all the flavors were kind of like Memphis themed stuff. And if you don't know, there's a pyramid here that has Bass Pro Shop in it. And it used to be an event center, like that, basketball concerts, stuff like that in there. But all the tea bags are all shaped like pyramids, and so their whole thing is about Memphis. But this is my first time ever drinking it. Interesting. So we talked about assets. Let's talk about depreciation for a second, okay? Because I think there's like this. I think there's some confusion in the world about you can go just buy a truck, right? And it's going to it's going to reduce your taxable income. It's going to reduce your net income, like whatever that is, right? And I think there's some confusion there. So buying a piece of equipment, buying a truck, buying a trailer, buying a tool that's over, there's some rules. It's either $2,500 or $5,000, and there's some it depends stuff that goes behind that. But if you buy that tool that's over that threshold, if you buy property, you buy all this stuff, like that does not just go on your income statement as an expense. Okay. You can't put $100,000 truck on your expense report or on your P&L as an expense. Doesn't work. What it does is it becomes an asset. Okay. And then it depreciates. So long-term assets, again, trucks, equipment, tools, buildings, property, things that you're going to keep for a long time, they lose value over time traditionally. So the way that accounting works is you use depreciation and it spreads the cost of that asset over the course of several years, the years that it's expected to be used, right? So there's a lot of different years that you can use. I think there's like 3, 5, 7. I think buildings are something like 20 years. I don't know all these rules, but it's spread out a lot. Okay. And so every year, a portion of the asset's original cost is recorded as depreciation and it reduces the book value. So it reduces the value of the asset that's going to show on your balance sheet. Okay. So if you take a $100,000 truck, you depreciate it over 5 years, that's $20,000 a year. So on year 1, it's worth $100,000 on your balance sheet. Year 2, it's worth 80. right? Then year 3, it's worth 60. So you see, it reduces the value of it. Now, there's bonus depreciation, okay? And that's the thing that people want when they say you're going to go buy a piece of equipment, you're going to go buy something to reduce your taxable income. That's the thing people are going after, right? Because now just know there are rules around that. So make sure whatever thing you're going to go buy and the current situation of your business, make sure that it makes sense for you to go out and buy that $100,000 truck. Because if your company's only made $20,000 this year, you get to October, November, it's only made 20 grand. You go buy $100,000 truck, you can't depreciate $100,000 this year, right? They're not going to let you go into a negative. So bonus depreciation, it's like Section 179 bonus depreciation. That's the thing that you are trying to do by buying a piece of equipment at the end of the year, buying an asset at the end of the year. So otherwise, it's going to depreciate over the course of several years. Depreciation is a non-cash expense, and it does go on your P&L. So again, the $100,000 truck spread over 5 years, $20,000 a year. So that means $20,000 a year goes into your expenses on your profit and loss statement, your income statement, as depreciation. But it's a non-cash expense. Bankers understand that. So hypothetically, if your business lost $20,000 and you had $150,000 worth of depreciation in there, bankers understand that. Okay. Anyone who's a financial professional is going to understand that. They're going to be able to look at it and be like, okay, I see. So just know depreciation's a thing. Didn't want to get too deep into that, but I felt like it was important to mention, right? We're talking assets, we're talking liability, we've talked income statements before. Depreciation is a thing. It's a pain in the butt to keep track of, is what it is. I mean, if you have one truck and one trailer, it's not too terrible, but you get to some point and you're like, holy crap, are these all the assets? Are all of our assets on our insurance list? Are they all being depreciated? Has all of this stuff been depreciated properly? Like, you go through this freak out thing, right? So I would say just keep in mind, as you're growing, you want to make sure you have a good list of assets. Keep record of all of that stuff, all the vehicles, tools, equipment, stuff like that you own. When you buy them, make a record of it. How much did you pay for it? Keep the document somewhere, because an accountant, a banker, somebody's going to ask you for it one day. So just make sure you keep up with that. I'm terrible at that stuff. 100% absolute terrible. And so I try my best to give all of that to somebody else who's good at it. But anyway, now let's get into liabilities. So liabilities are obligation that your company owes to someone outside. Yeah, we won't go any further than that. Owes to someone outside. So in simple terms, it's what your company owes. Assets are what you own. Liabilities are what you owe. Okay. I'm going to skip the disclaimer about the cash and accrual based accounting. You've heard it. You know what I'm talking about. So liabilities, accounts payable. We talked about accounts receivable as an asset. Accounts payable as a liability. So that's money that you owe to suppliers, vendors, subcontractors, whatever, right? You got a bill from somebody, you owe them money. That's an account payable until you pay it. All right. Credit card balances are liabilities. Be careful with your credit cards. Equipment loans are liabilities. Vehicle loans, line of credit. I'm going to touch on this line of credit just for a second. And I'm just going to let you know, a line of credit is not intended to be a long-term loan. You should not treat it as a long-term loan. And look, I'm not trying to beat anybody up. I know things happen. People get in situations. We all get in situations and we have to use it. But when we have to use it, we also have to work really hard to get it paid off, or go talk to our banker and say, hey, man, I can't get this paid off within the next 6 months or 12 months or 3 months or whatever that number is. Can we look at doing something different? Can we move this from our line of credit and actually turn it into a term loan? And assuming you have a relationship with your banker, they'll probably have a conversation with you and help you figure something out. But don't use it like it's a long-term loan that's just sitting there waiting on you to use whenever you want, because your banker, they will get tired of it and they will come to you and they will force you to do something when you don't plan on doing it. All right. So use it like it's meant to be, pay it off. Don't let it sit there forever. Payroll tax liabilities, Things like that are liabilities. Now, we talked about buying a truck. We talked about the depreciation on that truck. So let's talk about the interest, fees, anything like that that go on loans, right? They affect they affect your income statement, not your balance sheet. So when you're making payments on a truck, you have to separate principal from interest. Principal reduces the liability on the truck. Interest does not. Interest goes to your income statement. All right. So I know that this is a lot, right? It's a lot. And I get it. If you, if people have never heard about this stuff before and you just sit here and listen to me going on and on and on about all these things, like it just kind of hit me like, man, it's a lot. But anyway, just like assets, liabilities also go into two separate categories. It follows the exact same thing. So you have current liabilities. All right. So debts that are due within 1 year. I learned another thing whenever I was getting ready for this show with liabilities, and it blew my freaking mind. I'm going to tell you, but you're going to have to wait. So, examples of current liabilities are accounts payable. Again, money owed to vendor subcontractors, things like that. This is the crazy part, short term loan payments. Okay, so these are principal payments on loans that must be made within the next year, even if the loan itself lasts several years. The portion due in the next 12 months is considered a current liability. Now, I didn't know that. I'm assuming that our CPA knew that and just does it right and makes all our stuff right whenever he does his thing. But it was surprising to me. I didn't know it. And I said, oh, wow, that's crazy. And I did confirm, according to the generally accepted accounting principles, GAAP, you indeed are supposed to make entries and move long term liabilities to short term liabilities if you want a very accurate snapshot. Because remember, that's what a balance sheet is, a snapshot at a moment in time. Oh, obviously, maybe there's people in the world that do that every day or week or month or, whatever. I'm not. Right. I'm going to do that crap like at the end of the year whenever I have to prepare like a real financial stuff that goes to people. I would probably do it then. Past that, man, that's crazy. I'm not doing all that stuff. All right. Current, due within a year. We already talked about this. Accounts payable, short term loan payments, credit card balances. So this is the same as the line of credit. All right. Just use them responsibly. People get into a lot of trouble. The difference between a credit card and a line of credit is going to be a massive delta of interest. There's a giant difference in interest between a line of credit and a credit card. Okay. And that's where people get in trouble. You go put $50,000 on a credit card and like let it sit there for 6 months and make minimum payments or, whatever that is. It's going to be a huge amount of money that you just paid to have money sitting on that credit card. The line of credit is going to be a lot lower interest and going to be a lot better. But anyway, you also have credit stuff, right? I've always heard if the balance on your credit card goes over 1/3, it's bringing your credit score down. Credit score is important if you own a business because when you go to apply for a loan, they're going to want your information on that paperwork and they're going to check your credit just the same as they're going to check your business. And a lot of times, maybe you have to be a co-signer or you have to be a guarantor or something like that. You need your credit to be able to back that up. So protect your credit. It's important. Don't let money just sit on credit cards because, who cares, right? No. All right, payroll taxes that you owe, that's also current liability. Long-term liabilities. These are debts due beyond 1 year. We already talked about equipment loans, okay? Vehicle loans, property loans, loans for any kind of major purchase. Let's just lump it into that. Maybe you bought some land, maybe you bought a building, maybe you bought whatever. This could be like a big old saw, I guess, that you finance for 5 years, right? Any of that kind of stuff becomes long-term liability. Like I mentioned, I put this in here. Quick gap note. Even long-term loans are usually split on a balance sheet. The portion that must be paid within the next 12 months is moved to current liabilities, often called the current portion of long term debt. The remaining balance stays under long term liabilities. That was the thing that was crazy to me. Okay, so we have assets, right? Then we have liabilities. So the things that we own, the things that we owe, the difference is the equity. All right. So the technical, or I guess the paraphrase technical definition of equity is the owner's residual interest in the business after liabilities are deducted from assets. So to put that in simpler terms, this- equity is what the company is worth after all debts are paid. I don't like that worth word in there. I don't like that. So the owner's financial stake in the company after the debts are paid, not the same as what you'd sell it for, probably, right? The sales value is probably going to be based on earnings, market demand, some other factors. There's a lot of multipliers and like there's equations that go into what your business would sell for, and it is not your equity. Maybe there are times when it is, right? But I think typically it's not your equity. So think of it like this. This is how I think of equity. All right. If I did not sell my business and I just shut the doors right now, all right, went outside, locked her down, said, all right, we're done. We're going home. We then paid off all of the bills, all the money we owe, short term, long term, whatever it is, we paid it all off. We collected what everyone owed us. So all of our accounts receivable, which, yeah, that's another thing, right? If we were able to collect it all, then we would collect all of our accounts receivable, and the money that was left over, theoretically, would be the equity. Okay, we just shut the doors, paid off all our bills, collected all the money, whatever we have left in the bank, that's equity. Okay, so equity will include owner contributions. So the money that the owner personally invested into the business. I'll tell you another story about when I had a farm. And when I bought my first tractor and first couple pieces of equipment for the farm, like I was personally paying the note on all of that stuff. And so what I would do is when I paid the note, I would go put them in as contributions, right? Because I didn't think I could put the whole asset in as a contribution and then pay it. Maybe I could have, but anyway, any money that I personally spent for the business went in as a contribution. Retained earnings are in your equity. So that's profit that was kept in the company instead of being distributed to the owner. So if your business made $100,000 every year for 5 years and you never distributed any of that out to any owners, then your retained earnings would be $500,000. Accumulated profit is total profit the company generated over time that increased the company's equity. Honestly, I'm not sure that that's two separate line items. It made it in the notes. It might be, but I kind of thought that was just one. But and maybe it depends on how your business is structured, right? If you're a corporation, you probably wouldn't distribute money the same as if you were a single member LLC. So maybe that's where that is. Maybe that's why they're both there. But anyway, your company owns $2 million in assets and you owe 1.2 million in liabilities. Your equity is $800,000. Easy peasy. All right. Okay, so now let's look at what the balance sheet actually tells us. What does it even mean? Why do we care about this? Well, number one, do we have enough cash to operate? So there's a lot of companies that have looked successful and ran out of cash in history. Maybe some of you remember Lehman Brothers, right? So massive investment bank that owned huge amounts of assets tied to mortgages. And when the lenders demanded cash during the financial crisis, they couldn't raise liquidity fast enough and they collapsed. Okay, so they were profitable, but they didn't have enough cash, right? Silicon Valley Bank in 2023, just a few years ago, they held billions in long-term bonds, but depositors rushed in to withdraw money, and they had to sell assets at losses that were so big they ran out of cash, right? So you can have valuable assets, you can show profits, and you can still fail if you do not have access to the cash when you need the cash. Like, that's cash flow is a huge thing, right? So you really got your balance sheet, you got your income statement, and you got your cash flow. Okay. And all of those are such important pieces of the puzzle. So, are we carrying too much debt? All right. Because debt helps grow your business, right? Like, I'm not, I'm not trying to like advocate for debt, but I will tell you, I'm not afraid of debt. I was basically told from the time I was a kid that, hey, you're going to have debt, right? Don't get crazy with debt. Don't have too much debt. Make sure you can service your loans, but you're going to have debt. And I've just kind of never been afraid of it, maybe erroneously at times, even. But Toys R Us, 2017. So the company had billions in debt after a leveraged buyout. So much cash went toward debt payments that the company couldn't reinvest in stores or compete with online retailers, and they filed bankruptcy. Right? So they they spent all their cash paying their loans. That sucks. Hold on. I have to have a drink. This tea is very interesting. I don't know. I don't know how I feel about it. We can see our customers paying us. I honestly, I don't go to the balance sheet to look at my accounts receivable. I just go straight to the accounts receivable. There's reports in QuickBooks and stuff like that. I think is easier. But your AR, it is on your balance sheet. So, and it's an important number. Okay, so I do want to touch on it. I didn't want to just skip over it, but it shows how much money customers owe us. Now, one of the things that we spend a decent bit of energy on here in our fence company is collecting money, right? Because I will tell you a thing that is a really weird feeling is when you look at an AR and you're like, man, that's a lot of money sitting out there. And then you look at your bank account and you go, man, that is not much money sitting there, right? And you're like, oh crap. And then you go start digging into your AR and you're like, wait a minute, these people were supposed to pay 3 months ago. These were supposed to pay 6 months ago. These were supposed to pay 8 months ago. Like, why have they not paid? Right. And then, oh, wait a minute, I have to pay some bills next week. I have to pay some payroll this week. And like that's a weird place to be when you've done the jobs, you made money on the jobs, you did everything you're supposed to do, and the people won't pay you. And your money's all just sitting out there in receivables. That sucks. But you got to stay on top of a lot of things, and that's just one of them. So there was a company called Carillion. So they were a UK construction company. In 2018, they reported profits, but they had huge amounts of unpaid receivables that were tied up in projects. Cash never caught up with reported earnings, and the company collapsed when the liquidity ran out. Exactly what I was just talking about, right? You can have a bunch of money in your accounts receivable and you can run out of money and you can't pay your bills. That's why it's very important. Let me just touch on this for a minute. Since we do like to talk about commercial fence from time to time here on Powerhouse Fence Show, let's talk about some commercial fence principles. When you do a job for a general contractor, nothing is always, okay, don't shoot me if this is not the case in your weird situation. But typically, you can submit a bill on that job every single month. So you bill for material. You go out and you work 2 weeks on the job, bill something, right? Get that process started. In fact, I'd just assume my first bill be a little tiny bill. And that way, if I'm doing it wrong, I'm going to find out when there's not a lot at risk. Right? I don't want to go 1 or 2 or 3 months into doing a job and then submit a big bill just to find out it was wrong and they push me back another 30 days on getting paid. So use that first little bill after you've been out there a few days or you've done a little bit of something for the job. Use it as a learning experience and make sure that you understand the billing process for that contractor, because I promise you there's a lot of variation in that world. Okay. The due date, some of them won't let you submit a bill early. Some they won't let you submit the bill late. You have a window you can submit the bill in. The paperwork better be right. You got all your ducks in a row. You got your I's dotted and your T's crossed, or that crap's going to get kicked out. All right. You can look at your balance sheet and you can tell, are we keeping up with paying our vendors? A lot of times what I like to look at really is I like to look at my accounts receivable versus my accounts payable. Right. And I don't like when my accounts payable gets up close to my accounts receivable. That's when I start getting a little bit, what are we not billing? Right. Do we have some jobs going on that we've like bought material for, been billed for, and we haven't been on the job yet, hadn't been able to bill anything? Like what's happening? Okay. Let's talk about stored material for a second, because I just said all of that. I just said some things and I'm going to say some more things. So billing for stored material, it seems to have changed over the past few years. It used to be that if we were really good or really lucky, we could like order material and bill for stored material almost kind of at the same time sometimes. And then we would have the bill from the vendor that we could give to the contractor, and we would get paid by the contractor. And we could kind of time it to where those two got close, right? To where when the bill was due to the vendor, hopefully fairly close to that, money was coming in from the contractor, right? We used to be able to kind of play that game. Well, now it seems a lot different. And typically we have to pay for the material before we can bill for the material now. And we certainly have to have paid for the material before the contractor will pay us, which is, it's kind of, it's weird, right? But it's the game. You want to play the game? You play the game, or not. You don't have to. But yeah, that seems to be a lot more common now. So you can bill for stored material. Just figure out how you have to do it. Right? You can read, make a phone call, whatever it is. Be like, hey man, I need to bill for some stored material. What's the process? Okay. All right. Well, now you know the answer to the question, right? Now you know how to do it. But anyway, bill early, bill often. Keep that cash flow rolling. So are we paying our vendors? Again, this is the exact same thing as the AR. Really, I think there's better ways to get to this information than going to the balance sheet, but it is on the balance sheet. So yeah, you get a big picture idea on the balance sheet. Okay. So Kmart, 2002, a cash problem grew. Kmart delayed payments to suppliers. Ooh. Vendors began refusing to ship products without payments. Their shelves grew empty and the company filed for bankruptcy. Hmm. So there's probably some things that led up to that, right? Like, I don't think they just decided not to pay. I think they were probably struggling pretty good before they didn't pay. But yeah, that definitely sucks. Whenever I have had that experience in my life. Since I've owned Memphis Fence, I've had that experience where it's like, oh, hey, you owe some money. I'm like, hey, look, we're trying, right? Here's my AR. Look, I've billed it all. I haven't gotten paid. And vendors will kind of go, I don't know if I want to sell you anything else because you haven't paid for the other stuff. And like, you get to that point and it's not a good place to be, right? Because now you have other customers that you need to go do their job in order to get paid. I remember one time there was some issues on a job. It was a big project. We couldn't get paid, and the money was sitting out there in receivable. And the vendor was like, hey, where's the money? And ironically enough, the reason we couldn't get paid was because the material, right? There was problems with the material. It failed the test, and it was ordered to pass the test, and we got it and it failed the test. And then the vendor started jumping up and down wanting paid. And I'm like, dude, if you had sent us the material that would have passed, we would have been paid and we wouldn't be having this conversation. But anyway, that was a whole mess. It sucked. We lived through it. Here we are. And we learn every time we do something, right? And so we learned then, but we had other customers who wanted us to come do work for them. And because we couldn't get paid on that job, the vendor didn't want to sell us material. It was like messing us up on doing some other stuff. And I'm like, hey man, worst case, we don't get paid for this material, this job, then we need to do other jobs to pay you. So how does this make any sense? But I get it. All right. There has to come a time where you draw a line. But it all worked out. And here we are. We just kept going. All right. So we're 55 minutes in. There's a bit of stuff here. I'll kind of skim through it a little bit, right? I'm just going to touch on there's some metrics that people look at that come from your balance sheet. So working capital, um, current assets minus current liabilities. Remember, current on both of those things are within the next 12 months. So current assets is expected to be converted to cash within the next 12 months. Current liabilities is expected to be paid within the next 12 months. So that gives you a good picture of the capital that you're working with within the next 12 months. All right. Your short-term financial strength. Typically, positive working capital means you can comfortably pay your bills, when negative working capital means you might be in some trouble. We've already told a few stories about that. If you missed them, hit rewind. Be kind, rewind. Uh, your current ratio, current assets divided by current liabilities. So shows your ability to meet short-term obligations. Current ratio, debt to equity ratio, liabilities divided by equity, right? Shows your debt to equity ratio. All right. So we've already talked about, like I said, I was just going to kind of skim through some of those stuff. I have some more in here. Why profitable companies still go bankrupt. We've already talked about that, right? Receivables are slow, debt is high, cash is low. Like, man, it gets super stressful. This is you need financial information, right? You need to be able to look at it and tell what's going on. And you should look at it to tell what's going on. And you should watch, because you don't want to get to the point where it's like, holy crap, I have a problem, right? You want to be able to see it coming a little bit ahead. This is also a very good time to tell you it's essential that you have a relationship with your banker, because when you're in this scenario, you want to be able to call your banker, right? So your P&L told you if you make money, balance sheet told you if you were financially stable. So 2 documents, really important. Your accountant's going to clean some stuff up, but as long as you're doing basic stuff in QuickBooks and you kind of have things organized and have it right, then it's going to give you a pretty decent picture. If you don't have that, hold on. Let me have a drink. If you don't have your basic financial stuff in order, find somebody to help you do it. You didn't have time to do it the first time. You're not going to have time to do it now. Just find somebody to help, right? You can go to a local college. You can find what do they call them? The virtual people. I can't remember. Hmm. But anyway, maybe some of that stuff, right? You can find somebody that just helps you virtually through the internet, and maybe they're sitting in another country somewhere. Um, but I like college stuff. Maybe somebody that's retired and wants a part-time job, like whatever it is. Put some energy into it. Find somebody that can help you. Bring them in. Show them the issues that you have. You're gonna have to extend some trust and actually show them your financial stuff, and let them see what problems you're having, and let them help you out. Right. And let them get your stuff cleaned up and get you headed in the right direction. Make sure you have all the right accounts and everything like that in place. It's it's gonna make your life much better. I don't know if it's gonna, yeah. It's gonna make it a lot better for you, right? If you get that stuff under control and you can confidently go open your QuickBooks account or whatever it is. I've said QuickBooks 58 times. I don't even know what you're using, right? Let me know what you're using. But if you can go open up your accounting system and you can see what's going on, man, it's so nice. So nice. Okay, I'm going to stop talking now. Revenue is vanity, profit is sanity, cash is reality, but financial literacy is control. See you next time.